Everyone talks about the Great Depression of 1929. Breadlines, bank runs, Hoovervilles. It's a permanent scar on the American psyche, the cautionary tale for every economic planner and every central banker who thinks they've tamed the cycle. But what if I told you the real blueprint for modern financial crises didn't start in the 1930s? It started in 1873. And unlike the Great Depression, this one vanished from public memory. No Roosevelt, no fireside chats, no black and white footage of desperate crowds, just silence. Silence around the longest economic downturn in modern Western history, the one they now call the Long Depression. 23 years of rolling stagnation, bank failures, collapsing railroads, defaulting countries, and the quiet death of an empire's illusions, not just in the United States, but across Europe, Austria, Germany, Britain, even India. Official history tells you it began with a stock market crash in Vienna, or with a banking panic on Wall Street. Maybe it was the end of the post-Civil War boom in America, or speculative railroad bubbles. All technically true. But here's the paradox. None of those were the cause. They were symptoms. The real cause, the one hidden behind the stock tickers and telegrams, was a change in the monetary system. A switch so subtle most people didn't even notice. A shift from one metal to another. Silver. 1873 was the year the world began demonetizing silver. One country after another, starting with Germany, then the US, then the rest of Europe, moved to gold. Quietly, suddenly, irreversibly. What they called the crime of 1873 wasn't just a political slogan. It was a shift in monetary gravity, a revaluation of power. And like always, those closest to the levers knew it first. Gold creditors, city bankers, imperial treasuries. They stood to gain. Farmers, debtors, colonized nations, they stood to lose. And lose they did. For decades. That's why nobody talks about this depression. Because its victims didn't write the textbooks. And its winners wrote the rules that still govern the game today. Look closely, and you'll see a pattern that repeats. Every time money is redefined, so is power. To understand how the world collapsed into the Long Depression, you have to first understand the world it came from and the machinery that made it run. Picture the mid-1800s. The British Empire is at its height. Trains scream across the American frontier, cotton sails to Manchester, sugar ships out of Jamaica, and opium flows into China. Industrial capitalism is no longer just a theory, it's a global machine. And like every machine, it runs on fuel. In this case, silver. Not gold. Not yet. The 19th century global economy, the one that built railroads, paid armies, moved goods across continents, was fueled by silver coinage and silver-backed credit. If you're surprised, it's because history erased this part. But look closer. The United States minted millions of silver dollars. The Mexican peso, made of nearly pure silver, was the de facto global currency in Asia. China, for centuries, was on a pure silver standard. India's rupee, silver. The Latin American republics, silver. Even Europe, before its pivot, ran on bimetallism, a monetary system where gold and silver were both legal tender, fixed at a ratio. And silver wasn't just currency, it was strategy. You see, silver was more abundant than gold. That meant more liquidity, more coins in circulation, more trade, more credit, more debt, yes, but also more growth. And in the newly industrializing West, growth was everything. American settlers bought land and tools with silver-backed banknotes. German farmers mortgaged crops for silver coin. Indian laborers were paid in silver rupees that retained purchasing power across villages and provinces. And it worked for a while, because there was something silver could do that gold couldn't: circulate. Gold, by its nature, accumulates. It concentrates. It sits in vaults. Silver, on the other hand, moved. It traveled with merchants, passed through markets, and built the rhythms of daily economic life. But here's the hidden truth. This silver engine wasn't politically neutral. It threatened people, powerful people. Starting in the 1860s, a new elite began to emerge, one less interested in trade, more obsessed with debt repayment, government bonds, foreign loans, railroad syndicates. These weren't farmers or artisans, they were creditors. And to a creditor, silver was a problem. Because silver inflates. Slowly, yes, but over time, more silver meant more coins, more liquidity, and more price stability for the common man. But for a creditor, that's bad news. Inflation eats the real value of a loan. It reduces the power of interest. Gold, on the other hand, contracts. It limits. It disciplines. It deflates. Which means loans become more valuable over time, not less. If you're a banker in London, a creditor in Berlin, or a railroad syndicate in New York, you want gold. And after 1870, they got it. The trigger was geopolitical. Germany, newly unified under Bismarck in 1871, won the Franco-Prussian War and demanded reparations, paid in gold. France, bled dry, delivered. And with that gold, Germany switched from silver to gold. Quietly, decisively. That one move set off a chain reaction. Austria-Hungary followed, the Netherlands, Scandinavia, then the United States, and eventually the British forced India onto a gold exchange standard too. The world began to abandon silver. Not because silver failed, but because creditors won. And here's the dangerous part. Nobody told the working classes. Nobody told the farmers. Nobody told China, Mexico, India, the silver economies that powered the periphery. The entire global price structure was about to fall, and most of the world didn't see it coming. They had changed the rules of the game, mid-game. If that sounds familiar, it should. They do it with interest rates now, with credit ratings, with capital controls. The mechanics evolve, but the strategy is eternal. Redefine money, and you redefine power. From the outside, the switch to gold looked like progress. It was sold as modernization, a cleaner, more rational system, a currency worthy of great empires in modern finance. Gold was elegant, rare, and stable, they said. It brought discipline to governments and confidence to markets. But discipline for whom? Confidence for what? That's what most people didn't ask. Because at first, the transition looked like a miracle. The early 1870s were roaring. After the American Civil War, Wall Street was booming. New York banks were flush with deposits. Railroads were stretching from coast to coast, eating land like a metal snake. Towns were popping up overnight. Steel, coal, and oil magnates were becoming household names. In Germany, newly unified and swimming in French reparations, the government launched massive infrastructure plans: railways, industry, canals, a national bank. The gold from Paris wasn't just treasure, it was monetary ammunition. Even in London, the empire's heart, financiers praised the logic of the gold standard. It was simple, predictable, international. Gold didn't need translation. A pound in London meant $1 in New York, a franc in Paris, all convertible, all credible. Capital flowed like never before. You could now issue a railway bond in Berlin, sell it to a banker in Amsterdam, collect interest from a mining town in Colorado, and be paid in stable, gold-backed currency. No surprises, no devaluation, no silver shocks. It looked like financial alchemy. But here's what you weren't supposed to see. The entire machine ran on debt. Every railroad mile laid down in the West, financed by bonds. Every new industrial plant in Germany, financed by credit. Even agricultural expansion, grain silos, cattle drives, timber mills, funded by speculative lending. And that debt? It only made sense under one condition, that prices kept rising. Because as long as prices, for wheat, for coal, for land, stayed high, debt could be repaid. Farmers could sell their crops. Railroads could charge passengers. Shareholders could pay dividends. But when you switch the monetary base from silver to gold, you change the rules. Gold is rare. It doesn't expand with population. It doesn't scale with credit. So as more countries joined the gold standard and stopped minting silver, the real supply of money began to shrink, quietly, invisibly. And yet optimism didn't slow down. Quite the opposite. The illusion accelerated. In the U.S., the Coinage Act of 1873 passed with little debate. It stopped the free minting of silver dollars, essentially locking the country onto gold. Few people understood the implications at the time. The act was technical, buried in legalese, no press frenzy, no protests. But among those who did understand, the financial elite celebrated. Bankers in New York and Boston praised the sound money doctrine. Eastern creditors knew what it meant. Fewer dollars in circulation meant rising loan values, a quiet wealth transfer from debtor to lender. And so speculation continued. More bonds, more railways, more land purchases on leverage, because everyone believed the future would be richer than the present. It had to be. But the math was already turning. Imagine inflating a balloon, not with air, but with gold dust. That's what they were doing. Stretching the promises of tomorrow with a currency that couldn't keep up. And still, nobody questioned it. Why would they? Trains were running. Stocks were rising. Gold was flowing. It felt like prosperity. But it was a mirage. A golden desert stretching into forever with no water underneath. And like all mirages, it vanished the moment someone blinked. If you're starting to see how boom becomes bust, hit that like, and share this with someone who still thinks gold is always safe. It began in Vienna, May 9th, 1873. The Austrian Stock Exchange, one of the most powerful financial centers in Europe, collapsed in a single day. Not slowly, not over weeks, instantly. Brokers fled the building. Police had to shut the doors. The news spread like wildfire. Berlin, Frankfurt, Paris, a chain reaction no one could stop. The bankers called it a correction. The governments called it a temporary panic. But the truth was simpler, colder. Arithmetic had caught up with politics. The gold standard, now spreading like gospel across Europe and America, had created a tightening noose around credit. Prices for grain, for timber, for iron began to fall. Not from lack of demand, but from lack of money. Because every dollar or mark or franc now had to be backed by gold. Not silver, not paper, not promise. And gold doesn't multiply. Gold doesn't scale with ambition. And yet, everyone had bet on infinite growth. It was a mathematical contradiction. In America, the dominoes began to fall just months after Vienna. Railroad stocks, once the darling of the speculative boom, plummeted. J. Cook & Company, the prestigious Philadelphia bank that financed the Northern Pacific Railroad, failed in September. That wasn't just a bank. That was Wall Street's keystone. Cook's collapse set off a full-scale financial panic. Banks closed. Construction halted. Projects died mid-build. By 1874, over 18,000 American businesses had failed. In New York, unemployed workers marched in the first official protest of jobless men in U.S. history. It wasn't just a recession, it was a suffocation. And the deeper reason? The world had shrunk its own money supply in the middle of an industrial revolution. Farmers were hit hardest. Prices for crops like wheat and cotton dropped by half. But debts remained the same, or worse, became more expensive in real terms. It was a silent execution by interest. And there was no inflation to cushion the blow. Because the gold standard doesn't forgive. Debt owed in gold is collected in gold. Period. No matter how low prices go, no matter how hard times get, the system wasn't built for mercy, it was built for credibility. In Europe, the pain was just as sharp. German railways collapsed. French investors, already drained by reparations, lost fortunes. Even in Britain, the heart of finance, the credit squeeze triggered deflation and factory closures. And yet the narrative remained the same. Sound money must be preserved. Politicians, most of them aligned with creditor classes, refused to consider a return to silver. They called it inflationary and dangerous. But for millions, gold wasn't sound. It was silent. It didn't speak for them. It didn't account for their wages, their crops, their losses. It only answered to vaults. One man called it early, William Jennings Bryan, lawyer, politician, populist, would later describe the gold standard as crucifying mankind upon a cross of gold. But the crucifixion had already begun in the 1870s, quietly, slowly, across oceans and continents. And the worst part? It didn't end quickly. Unlike the 1929 crash, there was no dramatic recovery, no massive stimulus, no FDR. The long depression dragged on for 2 decades in some countries. The U.S. only fully escaped in the 1890s, after the discovery of new gold supplies and a partial return of silver coinage. In the meantime, bankruptcies kept coming, wages kept falling, and resentment kept building. It wasn't just an economic crisis, it was a redistribution of power, from debtor to lender, farmer to banker, periphery to core. And that's why it stayed out of the textbooks. Because what collapsed wasn't just a market. It was the myth that money could be redefined without consequence, that you could quietly tighten the system and the people wouldn't notice. But arithmetic cannot be deceived. If this part connected dots you never saw before, share this video. It's time we remembered the depression they forgot to mention. If you think the Panic of 1873 is just a dusty footnote, think again. We're still living in its shadow. The mechanisms that triggered the Long Depression, sudden shifts in monetary systems, silent wealth transfers from debtor to creditor, deflation weaponized as discipline, they didn't end in the 19th century. They evolved. The 1873 crisis taught central bankers and financial elites one core lesson. If you control the definition of money, you control the direction of history. So they made sure they never lost that control again. Fast forward to today. You hear terms like quantitative easing, interest rate hikes, currency devaluation, monetary tightening. Sounds complex, but underneath it's the same pattern. Expand credit, extract value, tighten the system, shift blame. In 1873, they called it the Coinage Act. In 1971, it was Nixon closing the gold window. In 2008, it was Lehman Brothers, then a global liquidity freeze. And in 2020, it was trillions printed, followed by a silent war on savers through inflation. Each time, the formula repeats. Promise growth, fuel it with easy money, then pull the rug at the top, when insiders have already exited. The result? Those who owe, households, workers, nations, suffer. Those who own, capital, institutions, reserves, consolidate. And just like in 1873, most people don't understand the rules changed until it's too late. Let's take one example, deflation. It sounds like a win for consumers. Lower prices, right? But what if your debt stays the same or grows? What if your wages fall faster than your rent? That's not stability, that's strangulation. The same thing happened to farmers in the 1870s. It's now happening to middle-class professionals, small business owners, and entire economies trapped in dollar-denominated debt. Just look at Argentina, Turkey, Sri Lanka, nations locked into a monetary regime they didn't design, where tightening in Washington means recession in their streets. That's the modern gold standard. Except now, it's called the strong dollar policy. A polite way of saying, we print it, you pay the price. And what about silver? It never recovered its role. The metal that once made global trade possible, erased from the monetary system, not because it failed, but because it empowered the wrong class. Silver helped farmers, merchants, laborers. It kept money in motion. Gold, and now fiat controlled by central banks, helps vaults. They buried silver. Then they buried the memory. That's why nobody talks about the Long Depression, because its victims aren't around to tell you. And its architects left behind blueprints, still used today, just in digital form. 1873 wasn't just a crash, it was a template, and the template is still live. Here's the truth they never print on the front page. Systems don't collapse because of bad intentions. They collapse when numbers outgrow reality, when promises outrun production, when the math no longer fits the lives it governs. The Long Depression wasn't caused by greed or stupidity or a one-time mistake. It was caused by something far more dangerous, belief. A belief in sound money that ignored real suffering. A belief in gold over people, in contracts over crops, in debt repayment over human survival. And here's the warning. We're doing it again. Every era invents its own version of financial truth. In 1873, it was the gold standard. In 2008, it was deregulated banking. Today, it's digital liquidity, algorithmic trading, and central bank tools used without public consent. But the deeper mechanism hasn't changed. We still measure human life in abstract tokens. We still sacrifice the many for the stability of the few. And we still believe, fatally, that numbers are neutral. They're not. Every economic rule is written by someone, for someone. And every time a system is tightened, you have to ask, who benefits? Because here's what history teaches us. When you redefine money without including the people who live by it, you don't just shift value, you strip meaning. A coin only has power if people trust it. A contract only matters if it serves life. The moment you forget that, your empire starts to rot from the inside. And whether it's the Roman denarius, the French assignat, or the dollar printed on a Fed spreadsheet, the decay always starts in the same place. Disconnection. From labor, from value, from the people who make the world real. So remember this, when the next adjustment comes, whether it's digital currency, interest rate hikes, or fiscal tightening, look not at the headlines, but at the fault lines. Follow the suffering. It always shows you where the real economy lives.